Good morning, everyone. Happy Friday, and welcome to today's webinar on successfully distributing private funds to retail investors in Europe. I'm Michelle Noyes, Head of Americas at EMA. Now, it might seem odd to have an American moderating today's conversation on a European topic, but increasingly, US firms are seeing how they can approach the retail market opportunities in Europe, given the success they've had in similar US channels. Today, we'll be talking about the European Long-Term Investment Fund, or ELTIF, a regime that allows managers to reach out to non-professional investors on a pan-European basis. And again, through my participation, trying to put it in a uniquely American context. This is a topic near and dear to the Alternative Credit Council, EMA's private credit affiliate. Recent ELTIF reforms are a culmination of a multi-year advocacy campaign. You can think of it like a regulatory version of a Taylor Swift tour, taking in all the key markets and regulatory institutions. As a reminder, Europe has 27 finance ministries, 27 securities regulators, plus European institutions who all need convincing. Our advocacy focused on three core pillars: highlighting the value of liquid assets to investors through our Financing the Economy research, highlighting the value of having retail private wealth capital provide financing to SMEs and mid-market businesses, and detailing the ways in which the ELTIF could be enhanced to get a broader take-up. As a result of this work, ELTIFs can now invest in virtually the full range of private market strategies, have greater flexibility around product design, and be marketed and distributed to retail clients much more efficiently. We'll be getting into all of this today: the market opportunity, the ELTIF framework, and strategies for distribution success with an esteemed panel of investment managers, legal, and professional advisors. While I have plenty of questions to guide our conversation, I would encourage all of you in the audience to also make use of that Q&A tab to add additional questions of our own. So let's get right into it. I want to first start with a practitioner perspective, and we're thrilled to have Vivian here from Apollo. So I'd love to ask Vivian first how she sizes, and she and her colleagues at Apollo size the European opportunity, and really think about how does that compare to the market in the US.
Sounds great. First, thank you for having me, Michelle. It's really great to be here. So to answer the question, the European market opportunity is certainly very substantial, clearly a part of the reason why I'm here. But to frame, I think market studies have generally estimated that global individual investor wealth is roughly, I would say, it ranges from like 150 to 170 trillion, with the current addressable assets at about 65 trillion. And while the US market is certainly the largest at roughly 30 to 40 trillion of that, the European market is very much the second largest opportunity there. So you'll see kind of estimates ranging from 15 to 20 trillion dollars in size. And so excitingly, these assets held by individuals in the regions are estimated to grow, I think, at a roughly 4% CAGR based on various studies over the next few years. And so certainly an area of interest. Bringing this to, I would say, alternative investments, perhaps more specifically, a more traditional institutional investor, as many of you know, have, I would say, an average 15 to 20% alt allocation. But I think where we're particularly excited, especially as it relates to the ELTIF regime, right, is the retail investor is significantly underallocated at roughly 2 to 3% of alt. And we obviously expect to bridge that gap, hopefully, and to, expect that to naturally grow meaningfully. And so, when we compare that to the US, like we're already starting to see that adoption take place, especially among high net worth investors, but there's still a lot of room to run and education needed to bring adoption higher. And for Europe especially, I would say that the cycle is a little bit earlier, but we're starting to see that, I think, take place as well.
Thank you, Vivian. That's a really exciting backdrop. And I think it's also important to stress, European vehicles can also be important to reach an audience globally. We've seen that with UCITS, and I imagine this is something you're also seeing as you think about your European strategy.
Definitely. Yeah. Asia and Latin America are definitely large markets as well. I think like collectively, they're roughly 8 to 10 trillion dollars in size. And to your exact point, I think one thing we learned from the UCITS market is that European domiciled vehicles in particular are certainly well consumed across non-US markets. And so this really much sets up a great framework for taking a similar approach when it comes to semi-liquid and ELTIFs under the same domicile, and also a familiar regulator.
Fantastic. And I think it's always helpful to start with, the commercial viewpoint of why we're all spending the next 54 minutes learning about this topic. But to layer on a more technical lens, Stefan, I'd love to bring you into the conversation and just really level set, what are we talking about? What are we looking at in terms of a framework when you're thinking about your investor access in the EU, and sort of how do some of these European definitions stack up with the American concepts that we're used to in terms of accredited investors and qualified purchasers?
Sure, sure. The investor access in the EU is basically twofold. On the one hand, there's the access to funds investing in listed assets, and the US calls them our public funds. And in the EU, you link it with the UCITS regime, but this is not our topic today. So I will switch immediately to the other part, which is actually the access to private assets. And the access to private assets, and the US calls them the private funds, there the situation is a little bit more complex, and it depends on the investor base which you are looking for to target. And in this respect, if it's intended to go for sophisticated investors in the EU, and the US calls them accredited investors or qualified purchasers, then we have the professional investor concept in the EU. And this professional investor concept is linked with the MiFID, but also with the AIFMD concept. And under the AIFMD, you have the passport regime, which is the go-to solution whenever you go for the more sophisticated investors. Whenever you want to target less sophisticated investors, or to call them retail investors, then of course you will face situations where you need to have a sort of a country-by-country analysis, because some countries have actually an extension of the so-called AIFMD passport. If you look, for instance, to Germany, because there you have actually a semi-professional type of regime. And other countries, they follow a national private placement regime. And this is something you can see in some of the countries in Europe, where it is possible to target some retail investors next to the professional investors, but not on the basis of a passport. Here you really need to tackle it individually on a country-by-country basis. But you have also countries where this doesn't work, for instance, in France, or where it's practically difficult to achieve, like in Spain. And therefore, we have the golden way, as I call it always, and the fantastic marketing opportunity. You have a fantastic European label, which is called European Long-Term Investment Fund, as you mentioned it at the beginning, the ELTIF. And this allows actually to extend the passport regime, which is available for sophisticated professional investors, also to the retail sphere. And this is something which is one of the go-to solutions everyone wants to put in place at the moment, and where we will surely speak a little bit more in detail. And just two regulations or two legal frameworks to consider on top of it, of the UCITS and the AIFM and ELTIF regime, is of course the MiFID regime and the PRIPS kit, the so-called packaged retail and insurance-based investment products, which is a sort of a product information you need to hand out in the context of a retail distribution in order to be very transparent and to provide an additional layer of investor protection. And at the moment, the European stakeholders discussing about a European retail investment strategy, and they are further nail down the rules about liquidity management when it comes to the design of semi-liquid type of products in the ELTIF sphere.
Awesome. And we will be coming back in just a moment to really dig into what ELTIF means for those of you who have not, are still rather fresh to this concept. But I'd love to bring Oisin into the conversation, because I know you and your colleagues at Waystone have a long history of talking to American funds about European market access. And I wonder, just like at a very, very high level, what is the appetite? Are American funds really, has it been ramping up? Has it been directionally greater interest in expanding to Europe? How has that evolved?
Yeah, and thanks, Michelle. I'm delighted to be here sharing some thoughts. So what's actually interesting kind of in a couple of minutes that we've spoken, we've mentioned UCITS 3 or 4 times already, right? And I think that's because outside of UCITS vehicles, for US managers and even European managers, accessing retail investors has been such a challenge when it comes to private markets strategy. So all that's really been there has been UCITS products, which don't allow kind of this private markets access. We have seen with the managers that we've worked with, we have seen success in the wealth management channel. So kind of utilizing the Luxembourg SCSP or even the Irish ICAV and some examples to kind of build conduit feeder products. But that's really only been targeting the high net worth market and hasn't really given access to the retail market. The initial LTIF product, so LTIF 1.0, as everyone likes to call it, again, there was a bit of hope there that might open up some retail channels, but really it was only kind of French and Italian focused products that we saw any sort of movement on. So kind of outside of that, then the last area where we've seen a bit of success has been the Luxembourg Part 2 fund. So that's kind of been the shining light, I guess, in European retail distribution. But the problem with the European Part 2 fund, and kind of Stefan started to allude to it, is that you're not benefiting from any European passport. You're going country by country, with some countries actually shut out in terms of kind of retail access. So we're very excited with the LTIF, with the updated LTIF scheme. Our clients are very excited. They see the opportunity in having something that can actually be brought around Europe and ultimately can generate access, can generate scale. Europe is, as you touched on at the start, it's a massive market. There's massive opportunity there. So finally, we have a tool that can kind of unlock that retail, that wealth management channel fully and scale up products.
Thank you so much. And, right after we get Stefan's précis of what LTIF is, LTIF 2.0 is precisely, be coming back to you to talk more about that interest and the sort of questions you're hearing from your US clients as this begins to take hold. But Stefan, I think we've set the groundwork that there's a market opportunity here. There have been some reforms to LTIF that make this now a more attractive market. So let's lay the table and explain to everyone what exactly we're talking about when we talk about LTIF.
Sure. So actually, you have, when we talk about LTIFs, you need to. First of all, it's a European label, which is on the product side granted, so it's supervised by the regulator. They need to grant you actually this label, and you run through an approval process. And if we speak about key features, we speak about key features on the investment universe side and on the investor side. On the investment universe side, to put it this way, we can say that an LTIF, the idea is a little bit like in the US private funds sphere, to be able to invest in all type of private assets, including private equity, private credit, and this is very important also, I think, for the audience, real estate, infrastructure. And the LTIF is designed in a way that they are quite open in these type of asset classes. You can have also mezzanine structures, etc., debt instruments. So on the asset, the universe side, the asset side is quite large. And whenever you want to structure an LTIF, which allows also for a certain liquidity in the sense of a semi-liquid product, then of course you need to bring in some short-term type of investments, which then deal with the second pocket. And the second pocket is also foreseen by the LTIF regulation, because you can invest in everything what is also listed eligible from a user type of view. So, and this pocket is exclusively to be reserved for redemptions. On top, and this is maybe something which may be interesting for asset managers operating globally, there is no geographical limit on the asset side. If you look to it, it's unlike a US BDC where you have the 70% limit where you need to focus on the US. There is no minimum expectation when it comes to LTIF investments on the global side. So this means that an LTIF could theoretically be run fully with Asian type of assets. There's maybe one geographical specification to be done when it comes to when you want to run a secondaries type of strategy, fund of funds, because there is a limit that you need to invest in EU alternative investment funds. And this is maybe something which is especially coming through the ELTIF 2.0 and which opens a little bit the market, because a lot of ELTIF managers had struggled with not being able to invest through fund structures. And this has been allowed, provided that the target fund itself does not follow another fund strategy. And just to say, you can plug in your ELTIF product alongside other strategies. If you run your US strategy, you run your EU strategy, you can run next to it your Asian strategy. And then ELTIF is then, of course, the go-to solution, because you can easily reach out to more than professional investors when it comes to the EU 27. One point, you can make cash borrowings also in the ELTIF context. It's absolutely fine, but it comes with a limit of maximum 50%. And you need to take into account diversification rules, roughly 20%. This is known also in several countries. So it's not really such a brainer to bring in the 20%. We have some concentration rules to comply with, but this is all very much generous if you look at it from an investment point of view, and it's very in line what in any case the market is already doing. On the investor,
can I clarify one point? Did you say 50% for that cash borrow limit?
Yes, 50 indeed. To the extent that you want to distribute to retail investors, which is one of the main goals of an ELTIF. There's a little bit more flexibility about all these rules to the extent that you want to limit the distribution to professional investors only. But this is for specific models, and I think for the purpose of this webinar, I think we focus more on the retail side. And just to say, on the investor base, you can again market to retail investors. There is no minimum size when it comes to the ticket, which is quite important. So theoretically, you can run an ELTIF like in a crowd-funded approach, but obviously you need to cover the operational costs. So there is, of course, a de facto economic limit. And maybe one point to take into account is that typically the investors need to run through a suitability test when you go for the retail. And there, when you ask now yourself, how can I deal with it? Of course, you will appoint delegates taking care of this, placement agent distributors who are dealing with them potentially already in the UCITS context, so they have the sufficient licenses in place and they can help you.
Awesome. So again, the things that stood out to me, you have a great flexibility across all of our favorite private market asset classes, geographic flexibility, considerations around things like diversification, but 20% giving, quite a wide margin there, and the ability to do some cash borrowing. So, flipping back to Vivian, you are one of the managers who has now gone through this. Can you talk us through your experience in launching an ELTIF fund?
Sure. So Apollo recently announced the launch of the Apollo Green Transition Equity ELTIF, or what we like to call ACT Equity ELTIF, just so it's easier. It's a little bit of a mouthful. This fund is actually on our Luxembourg-based Part 2 product umbrella, authorized by, obviously, the Lux regulator, and as you heard earlier, allows us to reach across the continent and looks to provide options and access points, I would say, across asset classes. At a super high level, though, the ACT Equity ELTIF is designed to provide wealth investors, obviously in Europe, but also even beyond, with greater access to PE opportunities focused on transition to clean energy and sustainable industry. And I would say, as Stefan knows very well, we've been monitoring the ELTIF for some time. The regulation has obviously been around for quite some time, but we were particularly excited to see the 2.0 changes come in effect earlier this year. And we do think that those changes will certainly help the vehicle move towards its original goal, frankly, of democratizing sort of access to private markets, making them more available to the broad range of investors, especially individual investors. And I would say, like with any new product structure, there's a lot of research and a lot of client conversations to really understand, what they were looking for and making sure we had the product and the exposure that they wanted us to offer. Now, as you heard, you can technically wrap all types of asset classes and things, and there's flexibility to have an even co-invest alongside your existing strategies. And so it very much was about trying to optimize what our clients were looking for and what we felt we could deliver within those legal constraints set out in the LTIF regime. So perhaps a bit, I would say, serendipitous, but given the continent's focus on ESG and responsible investing, as well as I would say our firm's fairly public commitment to being a leading provider of capital for energy transition initiatives, this felt like the right strategy to work with our partners on and to integrate into an LTIF wrapper to reach retail investors in Europe.
Awesome. And we'll be coming back to that ESG point because it is a really critical one. But Oisin, I'd love to hear from your perspective again. What are the conversations like? First of all, are most of the U.S. fund managers aware of that this vehicle exists? And what is the reaction and sort of take up been so far?
Yeah, so I think firstly, I think Europe has done a very good job in educating and making noise locally. That has garnered a lot of interest from US managers, and kind of when you marry the LTIF 2.0 and the work that's been done there by the Commission and others in kind of upgrading the legislation, when you even look at the UK LTAF scheme and kind of how they're opening up retail channels, the US managers really do see the opportunity in Europe and see the opportunity that the LTIF brings. Actually, on top of that, another exciting kind of headwind to this story is the European Commission's retail investment strategy, which they have brought out kind of around educating retail investors in Europe around looking at kind of longer term investing, educating them around things like investing in private markets, and kind of starting to look at maybe building that gap that's starting to appear in kind of pension schemes and different things there. So I think all of that combined with the success actually US managers have had on the ground here in the US with kind of BDC products, interval funds, kind of REIT products, things like that. I think when you combine the noise out of Europe with the success that managers seen here in the US with kind of similar style products, it's the perfect storm for kind of bringing products to market that will be successful in LTIF wrappers.
Thanks. And, let's see if we can bring some numbers to this anecdotal, the firsthand experience, the sort of general anecdotal environment. But Stefan, can you speak to how many LTIFs have been launched generally by US funds specifically, generally how fundraising is going in these products?
Sure. So there's an ESMA register available, which puts a little bit more details in all the numbers. It is a little bit it's not a live stream, so we take all the numbers a little bit with what is the latest communicated information, and there we have roughly 102 LTIFs which have been launched across the European Union. It could be either in the form of a standalone or it was a sub-fund of it, but in any case it has been labeled as an LTIF. And roughly, when I was counting through, I saw that there are 12 LTIFs, or let's put it 12 LTIFs, which have been launched by US managers. So you see that there is still some space left. And if you look what are the preferred hubs for it, you see that Luxembourg is actually the preferred hub because you have like 65% of all LTIFs are basically based in Luxembourg. And on the asset under management side, there is no publicly available statistic, but what you can see is that in general LTIFs target around 150 to 220, 50 million as a target size for the investors. And a lot of them, to the extent that they're closed-ended, they may not yet been fully invested, so you have not been fully drawn down. But you see that there are some LTIFs which were a little bit bigger. There's one having more than 1 billion as a fundraise so far. So it's difficult to say in total numbers, but it's definitely increasing. And so it's there was a figure which was communicated a couple of years ago, but it's my understanding is not appropriate. If I say now 12 billion, it doesn't make really a sense. It is more that I think if you look to the individual side, you will see that this is really 150 to 250 million, and then you could make the mathematics about all 100. So I think there's a huge potential.
Awesome. And, again, understanding that some of these reforms are quite recent relative to the longer track record of LTIF, it is interesting to look sort of at the more nascent activity that's going on post-reform. A few of you had alluded to it, but, ESG is an important conversation, and I'm going to bring Antoine, who's been waiting patiently here, to talk a little bit about it. And there is no ESG requirement embedded in the regulation, but it is an important item to think about when marketing to European investors. So can you unpack that, Antoine?
Yeah, that's right, Michelle. Thank you. And it's not me saying it, it's Viviane already, right? But indeed, I mean, there is not in, per se within the LTIF regulation any specific ESG requirements. However, it's crucial and it's a very important element to take into account when you think about an LTIF. First, because the type of asset class we're targeting and a bit the way the overall philosophy of the LTIF regime is very much aligned with all the objectives of energy transition, etc. But also it's and as Viviane illustrated, but also it's important because if you're targeting retail investor in the EU, this is something that they have, they care about, they have center in mind, and so especially coming from a US context, this might be different from what you have at home, and I will let Oshin comment on that a bit later. But it's definitely important in the EU. And once we have said that, the next thing we have to say is that it's also let's say a tricky or a dangerous environment in the EU, similar to what is the case in the US, because you do have a quite dense regulatory framework by now around the topic that's been rolled out over the last few years. And of course, what comes to mind to everyone, very quickly will be the SFDR framework, which is just in a few words, it's a disclosure regime where, depending on how green you pretend you are, you're supposed to make more or less elaborated disclosures, which are generally referred to as the Article 6, 8, and 9. So it's different levels of disclosures depending on how ambitious your, let's say, ESG or sustainability approach is. And I guess by and large, this is a framework that's, of course, some things have to be improved, but it's been around for a couple of years now. And, I think most managers have wrapped their head around it and are sort of familiar with it. And they're comfortable with, I should make Article 8 disclosures, I should make Article 9 disclosures, etc. But once you target retail investor, that's not sufficient anymore, because you need to deal with other pieces of regulation, notably around the ESG preferences of retail investor. And this goes beyond the simple 6, 8, 9 categorization of products. And so you have to start dealing with things like the EU taxonomy. You have to deal with things like the PI consideration, etc. And so effectively, the ESG strategy for the EU when you target retail investor cannot simply be on, should I be Article 6, 8, or 9? You have to look at, do I want to consider adverse impact? Yes or no? Do I want to make taxonomy aligned investment? Yes or no? Do I want to make sustainable investment? Yes or no? Because the way you assess ESG preferences of retail investor in the EU is not linked to the 689 categorization. It's linked to the more detailed criteria. And so that's why we see more and more managers looking beyond the 689 categorization and focusing on more tailored indicators, let's say.
So Antoine, as maybe your typical American with awareness of all of these terms, but with colleagues in Europe who are subject matter experts, I just want to make sure I have this sort of understanding correctly, and you can walk me through it. So I will be vulnerable here. So your assumption is, okay, if you're running an LTIF fund, you should be prepared to be making some disclosures under SFDR article, will it be 6, 8, and 9, or a subset?
All right. So 6 you will have to because basically the Article 6 of SFDR applies to EU domiciled fund, and it's basically asking you to explain how you integrate, to schematize it, or the easiest way to understand it is how you take into consideration climate risk in your investment strategy. So this part of the framework is about, it's not about saving the planet, it's not about being green, it's about telling your investor how you're going to deal with climate change and how you're going to make sure that it's taken into account when you look at an asset, when you make a due deal, when you make an investment decision, and how you're making sure that this asset is not going to become a stranded asset, it's not going to be wiped out by climate change, it's not going to become inoperable because there are too heavy regulation, or I'm going to lose money because of some new tax, etc., or no one's going to want to buy the product. So everything which is driven by financial performance and really the risk side of things, Article 6, this is basically, you have to explain how you do it. And Ocean can jump on that a bit later, but that's a bit what the SEC is trying to do in the US as well with the climate disclosure rules. So really on the risk side. Beyond that, so as you go target retail investor, if you make any sort of ESG claim, you will most likely fall under the Article 8, which is, again, a transparency regime, which takes in practice the form of a template. So it's a couple pages, can be something around like 5, 6, 7, up to 10 pages, depending on how granular you are. But basically, you have some questions you need to answer to be very clear and transparent towards investor about what exactly it is that you're doing in the realms of ESG. So that would be the Article 8. It's basically when you're promoting ESG or when you go beyond this mere climate risk integration. And then for the Article 9, it's the most ambitious framework, let's say. This would be in the case where you have the intention of making only sustainable investments, where sustainable investment answers a specific definition. And what's sometimes confusing is that you could be an Article 8 and partially make sustainable investments, whereas the Article 9 is supposed to make only sustainable investments. And, so that's where sometimes the confusion can come from. And going back to targeting retail, when you're assessing ESG preferences of investors in the EU, you are supposed to ask them about sustainable investment, about alignment with the EU taxonomy, which is another regime listing some economic activities that are considered green by the European Commission. Again, this is really schematizing. And so that's how you assess the ESG preference, and it's not linked to do you want an Article 6, 8, or 9 product. So this is why you need to look beyond this mere SFDR product categorization, and it can be a difficult exercise.
Yeah, no, I appreciate you kind of going deeper with me on that, and hopefully that's been helpful to others who might have been having the same questions, because again, it's not, to your point, just about disclosures, but it really is more a full embrace of ESG and sustainability. And Vivian, how have you built this into your ELTIF product?
Yes, I think it's the approach is probably even broader than just the ELTIF. Because for the ELTIF, to that point, I think we can start with the Article 8, but clearly, as Antoine has properly laid out, there's so much more to it in that. And so, frankly, I think it's almost better to talk about it at a broader level, because our firm has certainly been very committed, I think I mentioned earlier, the energy transition theme, but just broader ESG in general. And I think we've been very focused on kind of scaling our coverage to make sure that we're incorporating it across everything we do, not just from investing into lending, but also just global operations in general. And so, I think depending on kind of looking ahead here, obviously this approach, I think, might seem like it might seem like it has to be tailored differently by region, but I think it's important that the approach in many ways actually allows us to be able to cater to the different preferences and views that different regions might have across Europe and for the US. And so, as you kind of heard Antoine lay out, especially in Europe, a lot of this really does feel like is driven by regulation. And certainly the prompting of stronger sort of ESG product offerings and being compliant with, the aforementioned SFDR standards, and obviously just having general accountability is a large part of that. And certainly, of course, the sentiment has generally been positive. But distributors also that we've been speaking to have been clear that they want this to be what I'm going to call a baseline part of their checklist. And so as a manager, frankly, just operating in this space, we've been focused, like I said, scaling our coverage, but not just in terms of people, but also via data reporting to really allow for that ESG integration, to ensure that alignment, and to be able to measure that impact kind of across these investments. Again, all of which I think actually lends themselves naturally to the expectations that the European market has for managers like ourselves. But I should probably stress this is not an easy task. Right. And we understand there's a lot that goes into this, even in the scoping phase, right? And keeping even up to date on the latest regulatory shifts. I think that's always, frankly, probably even the hardest part. And so we certainly lean on experts, right, to kind of consult us constantly on that, especially as they continue to evolve.
Yeah, and and this is certainly a space where EMA is doing quite a lot of work, and we have a team in London leading that, as well as a library of resources for members. But I do think it's important because, again, it just may not be quite the same mindset, right? Sitting in New York and thinking about these issues. And, when you want to be commercially successful in Europe, it's, having the right vehicle and being compliant with it is one thing, but, meeting the needs of your investors and how they think holistically, is quite another. So, I really appreciate you bringing that into the conversation, Antoine. And Oisin, again, in your role where you sit and, you're working with a lot of American clients on accessing Europe, do they get it? Is this, how are these conversations going?
Yeah, it's been an interesting journey. I think actually not just for US managers, but European-based managers and practitioners alike. I think the ESG journey has been quite interesting and has been challenging. What we have found is that firms who, particularly firms in the US and kind of non-EU firms, maybe that were always traditional or were always successful traditionally raising capital in Europe, that kind of when it came to the updates in SFDR and some of the increased disclosure requirements, it did take some time to kind of get their heads around what's been asked and why it's been asked. And kind of, if you look at the US landscape, which has been maybe a slower adopter of kind of ESG legislation and frameworks, it has taken some time. But I think we are at the point now where the majority of managers who are going to Europe, they understand what Europe is trying to achieve. They understand the kind of broad aspects of SFDR and what they're ultimately trying to achieve with it. And then frankly, they understand that if you don't build in some of this framework, that you're not going to be successful, particularly if you look at regions like the Nordics, who have always been traditional ESG investors, and kind of the retail investor. I think here, when we're looking at the LTIF in particular, I think that's an area where there will be particular focus around sustainable products and kind of what can we get out there that will meet kind of the ESG requirements that we want to take. I think it's Sweden who they've made a push for any funds being brought onto the public pension platforms in Sweden. If they're not Article 8 or Article 9, they're automatically ruled out. And I think actually some traditional products that were there are actually being dropped off the platform. And when you look at kind of the Swedish market alone and the pension market there alone, that's billions of dollars that is up for grabs. So long story short, I think that US managers are really starting to grasp ESG, are really starting to understand what's required, and are kind of building products that are tailored to the European market, stripping out maybe non-ESG aspects that they might continue to run in US funds, but kind of building in then the right aspects on the European side. So a lot of progress has been made, which is great.
Thank you. So hopefully, we've laid out the market opportunity and size, some of the practical considerations about what LTIF is and what can go into it. We've talked about ESG and why it's such an important consideration, even if it's not directly embedded within this particular rule. But I'd love to, just kind of round this out with a little bit more insight into not only how do you launch, but how do you be successful, right? We all know that it's one thing to get a product out the door, and it's quite another to have a commercially successful one that can raise assets and meet all the goals and aspirations a GP has for it. So, Vivian, putting you in the spot first as the GP that's done this, what advice would you give to a firm considering to launch such a fund? And what are some of the key lessons that you've learned?
It's a great question. I mean, I think we kind of heard this maybe in a few places earlier on, but like the key is really having a frank conversation with your distribution partners and your clients and really understanding kind of what they need and bring them into the fold almost. Frankly, this probably isn't LTIP specific, but it is in the sense that it's obviously the new structure that we're thinking through. But like general, I would say product development advice that I've received and I believe we practice, where it is certainly more LTIP specific is the reality that because you can reach an even broader audience, those who really may be seeing alts for the first time, you have to demonstrate that you're committed really to the marketplace and that you're working closely with your partners, not just on the design, but on the educational effort that's going to be required there. And that can certainly come in the form of like blogs, white papers, other things. But like, I actually think that the educational journey is a really, really important element here.
And a very like kind of specific follow-up question on that. How important is it to do that in the local language, for non-English speaking jurisdictions?
That's a great question. It's definitely very important. And like everything, especially it comes in phases, right? So like obviously you want to start with whatever you feel most comfortable in, but I'm a strong believer that like every fact card or KID should be like translated to the local language.
Awesome. And we're getting some great questions in the Q&A. So thank you. And I'll just definitely make sure we have some time to get to them. But Stefan, you've looked across these 102 LTIF vehicles. What are some of the commonalities for the funds that have been most successful?
Yeah, it was a little bit of work, and just to say that one of the points which I think are very important which is very important to highlight is actually that if most of the players which had a huge success, they had already a track record in place on the professional type of segment, and so they could be they come with a product which is already working, and they kind of either enlarge the product or copy paste a little bit the strategy. So that it's an element which is very important to take into account. The LTIF is made under the LTIF 2.0 also in a way that you can come with your success story and you can put it in a wrapper which allows you for retail. So you have to sell eventually a product which has an investment strategy which is ideally something straightforward so that the retail investor can understand it, and they have a story behind. And I think this is a very important point from a perceptual point of view that the retail investor will get it, and this is may imply, and I think that you may be also adapt a little bit what the other description, the one or the other description in the prospectus, in the commercial documents, because you want to reach not only the professional pension fund, but you want also to make sure that a certain size of or a certain category of retail investors will understand your product and embrace it totally. And I think the point from Vivian is very important and essential. It's education and the national language. It's even an obligation to have the fund documents in the national language. But I think one other point is really that you have the discussion. You make sure that you fully understand in the entire organization that it's a regulated product, because this may have an impact on the way you're operating. But I think what we have seen with some of the asset managers is we have been discussing with them the portfolio. We have tried to understand what they want to invest to, where are the hurdles, where are the discussion points popping up, to find ways to make it actually happen. And to discuss through and not to come up spontaneously when the transaction is happening, but to have the team already prepared for the operational side. And I think it's very important to bring on all persons who are involved in the project on the distribution, but also on the operation compliance side, so that when you have the investments to be made, that everyone is prepared and it doesn't come up as a killer of the entire project.
Awesome. So I'm hearing, again, on that education, it's both educating your client, but also making sure you are able to articulate a strategy in a way that resonates to them. So you sort of, I don't want to say bring it down, but you bring the investors up, but also making sure you're speaking, in plain enough words that it resonates and it makes sense. And then to your point, thinking through the operational implications, making sure you'll have, you'll be able to do these translations into the local language documents, and making sure any other, additional follow-on work is well understood in advance and properly resourced. And then Oisin, we've talked about and we've referenced sort of placement agents and distributors a few times throughout this webinar, but can you talk on a practical basis, will funds need new service provider relationships, new business relationships to do this distribution? What can they rely on already if they might perhaps have professional products or UCITS products set up?
Yes, so I think the service providers that you choose to partner with for an LTIF product, they're absolutely crucial to its success. Particularly again, when we focus on retail investors, there's zero room for error, right? So you really got to make sure that you get it right. And when you kind of start at the top and work down through. So when you look at the AIFM, for example, that you look to work with, whether that's your own internal AIFM or a third party AIFM, like in that scenario, you got to make sure that they understand the product, that they understand the matching of liquid and illiquid assets kind of in one semi-liquid product, that they understand the different nuances that the LTIF is going to bring with enhanced valuation cycles, the matching mechanism that's going to come into place, enhanced reporting, all of that. So choosing your party there and starting at the AIFM is extremely important. It's something we've been lucky in that we were one of the early movers in kind of bringing some of these products to market for our clients. So it's an area that we've invested heavily in around making sure that we have the adequate tools for our clients there. And then kind of when you move down through then to your administrator, your depository custodians, working with a group that really understand, firstly, what a kind of larger retail book could look like coming into these products and how you manage that and how you manage the higher volumes, and kind of marrying that with the deep alternatives experience, being actually able to bring the two together under one house. That's absolutely crucial. Also, these products, there's going to be numerous moving parts that are going to make them complex and difficult to manage. So not having those partners around the table, they're going to be crucial from a products perspective. And then, Michelle, you touched on kind of placement agents and distributors. That's probably the next biggest thing that you need to focus on, because it's all well and good having a lovely product that works, but if you're not getting the product into the right hands of the right investors, then it's not going to be successful. And when we look at kind of the private markets groups in particular, who are looking at kind of accessing these new retail and wealth channels, they have experience distributing to institutional investors alone. So they don't have experience in a lot of scenarios and kind of going down to these wealth management and retail channels. So partnering with the right groups to firstly get your product into the right channels, and then ensuring that you're on the right platforms, because that's going to be key to this as well, right? You're going to be in the right channels, but being on actually the right platforms, being in the right shop window, as we like to say, it's going to be extremely important. And kind of Europe, it can be somewhat fragmented as a market, so that might mean that where you've had one placement agent that's carried your product to kind of the institutional investors across the region, you might need 4 or 5 different banks or different platforms across the region to really get your product out there to the kind of mass retail and kind of individual investors. So really sitting down and focusing on your strategy and who you're going to partner with, they're really, really crucial to being successful here.
And Vivian, does that match your experience? Did you have to set up new distribution relationships for this particular fund?
Yes and no. I think part of it is like, if you have people, I think, dedicated to coverage, on some level, it's maybe like, on some level, it's more about just taking the conversation a different direction, if that makes sense. But like, generally speaking, I think that's right. I think you've got certainly what I'm going to call, hopefully this is the right phrasing, local sort of European sort of platforms and players that have already built up connectivity and that we're plugging into and are actively looking for ways to expand. And then you also do have, I would say, increasingly classic, I would say, US platforms that are trying to find ways to, I think, build that connectivity as well. And so to be frank, I think we've looked at both options and I've looked at it in both ways.
Thank you. So Stefan, I'm going to do a little bit of a quick fire with you for some of these questions that have come in. So first one, can LTIF be open-ended or only closed-end?
It can be semi-liquid, so it can be open or closed. It's absolutely possible, but of course you need to take into account that there are discussions at European level at the moment about level 2, so about level 2 when it comes to the liquidity management provisions, and there's maybe an additional layer of regulatory points to be taken into account whenever you plan to go for a semi-liquid strategy.
Okay, so both with a little bit more work to do if it is open-ended and liquid. Okay, question 2. Is it possible to pre-market an LTIF? Does the position depend on whether you want to pre-market to professional or retail investors?
So the good thing about Europe is not only the marketing regime, but it's also about the pre-marketing regime, which of course had a huge impact whenever you wanted to test the strategy in Europe. And there was the cross-border directive, which came into place last year, and effectively this is addressed to professional pre-marketing. So there's no harmonized system whenever it comes to retail or non-professional pre-marketing, which means that if you want to do pre-marketing for retail, then you would need actually to check still on a country-by-country basis because there's no harmonized system in place. But for the time being, I mean, we have seen this question a couple of times, and there are very few countries where you could theoretically go this road, but if not, it remains a little bit as you see in the UCITS, where you don't do in the UCITS sphere, where you don't do actually pre-marketing. So you stick in the pre-marketing with the professional appetite, but you don't do this really in the non-professional.
Awesome. And, somewhat related, do you have to passport the LTIF into each jurisdiction, or can you respond to a reverse inquiry?
When we speak about the true passport, about the AFMD passport, then of course the AFM has a relevant license, has a relevant passport, and they will actually notify the relevant countries where they want to go for the marketing. So it is an information notification process, but it's not that you have now like you have it for the private placement regime where you have to undertake a sort of a registration process.
Wonderful. Well, I think we've covered quite a lot of ground in this conversation, and it's been really instructive to have the perspective of those who have done it, especially as an American, U.S. headquartered firm, and then, as well as the perspective of legal advisor and, broader professional service provider who can operationalize this. Got one more question. It's just about to wrap up. Anybody else get last call for questions? So Stefan, back to you as I interrupt my nice closing remarks in the interest of squeezing every last juice from this lemon. Does it make sense to list an LTIF vehicle to attract retail investors? So is listing an extra step that one would have to do?
I mean, an LTIF can make sense to the extent that you want to make use of an additional layer of liquidity, because we were speaking about semi-open-ended or a closed-ended solution, but you can definitely also think about a listing venue, and by this means you can organize a transfer, a mechanism by means of liquidity, and the LTIF is even incentivizing this because they have put in the LTIF regulation a clear statement that you may not prohibit to do the listing, which means that there is an underlying idea to organize liquidity differently. And by this means, you can go away from facing risks of certain redemption requests, and you would work with a transfer system. This we have seen this in the retail space, in the retail place already. We see this in the regulated fund world. So and this is an option. And apart from this, you could combine all of these type of options also when speaking about matching follows a little bit a similar idea. You have a transfer type of idea, which means that your commitment size remains neutral. It has no impact because you have an exiting investor and you have a new joiner, which is basically taking over the position. I think the listing venue is actually a very good venue, but for this, again, you need perception and you need the market. And I think now with having more than 100 LTIFs, I think there is, of course, an appetite growing, and I know that some stock exchanges are looking actively in it, including Luxembourg venue, because given that Luxembourg has one of the biggest LTIF hubs, of course, you can benefit from synergies in this context when you put this also in Luxembourg. But this I say because I'm working for a Luxembourg law firm.
Excellent question, Anand. I think that brought out another dimension of ways to success in this vehicle. I will also answer a question that came up in our prep call, related to, again, some of the appetite outside of Europe for these vehicles. So I was chatting with a friend who was recently in Chile with a Luxembourg delegation, because, again, we spoke about that these funds are not restricted to European investors, but have a broad non-US base. And she had indicated that it's still very, very new and novel, but, the rooms, kind of the breakout rooms on these sessions were quite full. So there seems an appetite for education, and one could expect then, the success that UCITS and other European vehicles have had in these markets, LTIF could also be quite relevant. So again, I think it's important that listeners think about this not only in a European context, but also as they think about Europe and Asia. But with that, we are officially at time. So please, thank you hugely to Vivian, Oisin, Antoine, and Stefan, and Stefan, for all of your work in pulling this webinar together. I know it's been something we've been speaking about a lot. I hope we fulfilled the goals of really demystifying it a bit. I know when you think about European regulation, it's a lot of acronyms, but it really is very, very dynamic. EMA has quite a lot of resources given all of the time we've spent on LTIF. So please do look at our website for more. I know also, Stefan, Oisin, Waystone, Arendt, you all have a great deal of expertise and would be happy to connect offline to continue these conversations. So thank you, everyone. Enjoy the rest of your Friday and speak soon.